Ladies and gentlemen, welcome to the world of option contract trading strategies and what represents the end of week 2. In the trading of options, I'd like you to know that we deal with a language, like every one of these products and investment vehicles, their own specialized language. And the language of options is no different to the language of variable annuities, to the language of municipal bonds, to the language of mutual funds. The proper trading terminology for the option, known as the contract, is called a derivative. The security is known as a derivative. Now the question is why? Well, the answer is that built into the option contract itself, as we go through and break down its features, there is another security. That other security could be a stock. It could be a interest rate. It could be a foreign currency. From now on, that other security that's built into the option contract itself is known as the underlying security, or the underlying. If we're dealing with equity option contracts, which means that the other security that's built into the option contract itself is known as a stock, then we're dealing with equity option contracts. Are you with me so far?
Yes.
It will be known as the underlying. Predominantly for most of the regulations that are on the Series 7 exams, I'll qualify. When we get into the areas of calculation, they are on equity option contracts. If you have 1 or 2 on foreign currency, you'd be lucky. Almost none on treasury bill option contracts or interest rate option contracts. The contract itself, which is the security unto itself, is betting on the direction of which way the investor believes is the underlying security that's built into the option contract will perform in the market. So we look at the trade from an option contract's point of view. And before I actually get into the trading of options with you, I wrote a quote here for you that I never want you to forget, because it's going to help you. All option contract trading is always looked at, viewed at from 7, the buyer of the option contract's point of view. The individual known as the holder of the option contract. The individual who went out and established a long position, paid the market price to own that contract. Point of view. Are you with me so far?
Yes.
Well, so we look at the trade from the buyer's point of view, always. Try to remember that. Are you with me so far?
Yes.
Now, there are only 2 players when it comes to options trading. This is a really simplified product when you get into it. There are buyers of option contracts, the holder of the option contract, the individual who went out and established a long position in the contract, bought that contract, the buyer, and then there on the other side of that transaction, on the other side of that same option contract, is an individual known as a writer. The word writer means seller. To write is to sell. So why don't we just say selling? Why don't we just say liquidation? Well, because the minute that we use the word writing, are you with me so far?
Yes.
We're talking about options. Just like the minute that we use the language associated with redemptions, we're talking about the sale and liquidation of mutual funds. Are you with me so far?
Yes.
Because every one of these products has their own specialized language. And so buyers are individuals who go out and pay the market price, however much that market price might be at that particular point in time, to buy that contract. Are you with me so far?
Yes.
Now, on the other side of that contract is an individual called a writer. The buyer is assigned with a writer. By whom? This third party that you read about called the Options Clearing Corporation. So if you went out and bought a contract and you paid the price to own it, are you with me so far?
Yes.
And you're known as a buyer, well then I would be on the other writer, the other side of that transaction as a writer, matched with the buyer over that contract. You and I never actually meet one another. We are assigned to one another by the Options Clearing Corporation. So the OCC is this third party in the middle that matches the orders between buyers and writers over the terms of that contract. Are you with me so far?
Yes.
Now, we are obligated to one another over the terms of that option contract, as you'll see when we trade, to fulfill those obligations to one another. Are you with me so far?
Yes.
And when we get into the different types of contracts, I think you'll see exactly what those obligations are. And so what I want to introduce to you right now are 2 players involved. Buyers, who are individuals who go out and pay the premium, which is the market price to own that contract. Are you with me so far?
Yes.
Is the option is a unique product in that it's the only security that we have in the market that is a one-sided price quote. All of the securities that I've taught you has a bid price and it has an offer price. Am I right?
Yes.
Not here. The option has a one-sided price quote. The market price to own that contract and establish a long position is known as the premium. Are you with me so far?
Yes.
The premium is made up of two components. It's made up of the intrinsic value of the option contract, and another name for the words intrinsic value mean the in-the-money value of an option contract. And we'll get into the definition of in the money or out of the money in a moment. First component of the premium is called the in-the-money value of the option contract plus the time value of the option contract. IV plus TV is making up the premium. Are you with me so far?
Yes.
Take a look one more time. The premium is made up of two components. The in-the-money value of the option contract plus its time value. These two components make up the market price of how much an individual must pay to establish a long position as a buyer and a holder to go out and own that contract. Are you with me so far?
Yes.
Buyers pay premiums. They pay premiums because they're buying and going long a contract, and that's the price you establish a long position at. Are you with me so far?
Yes.
And so we now have the two players, the buyers and writers. We talk about the premium, and I'm going to talk a little bit more about the premium in a moment, which is the market price of how much an option contract is worth at any particular point in time. And then we also deal with, of course, the two different types of contracts that we have. Two types of stock, common and preferred. Two types of annuities, fixed and variable. Two types of municipal bonds, go and revenue. Types are securities. Agreed?
Yes.
Yes? Two types of contracts. Call option contracts and put option contracts. Always look at these contracts, always look at the transaction from the buyer's point of view. When an individual goes out and buys a call option contract and pays the premium to go along that contract, he has the right, she has the right, if that individual chooses to step into the marketplace and exercise their contract, which means to do what the contract gives the buyer of that contract the right to do. Now, what does a call option contract give the buyer of that call option contract the right to do? To step into the marketplace, watch this transaction, and call away, which is another way of saying buying the underlying security built into the contract at a price called the strike price. Now, why is that price, which is built into the contract, called the strike price? Because that's the price at which you would strike the stock at. Are you with me so far?
Yes.
To strike the stock at, which is a call, if it's a call, is to buy or call away that stock. Are you with me so far?
Yes.
Now, that strike price is a fixed price. And then we break down the terms of this contract. You see here a fixed price of $40 a share. Are you with me so far?
Yeah.
That's called a strike price. This type of contract is a call. You go out and buy this contract and pay the premium. You would have the right, if you chose to step into the marketplace up until the expiration of this contract and call away, which is another way of saying what? Buying that stock. In this particular example, it's ABC. It could be Intel. Are you with me so far? Or Qualcomm. At what price? At $40 a share. Now the question becomes, through the terms and the eyes of your contract's point of view, why would anybody go out and buy a call option contract on an underlying security? Well, you hope that through your contract and its terms that you have an opportunity to call away and buy that stock at a cheaper price than where you expect that stock price to move in the market, which is hopefully above your strike price, which would mean that you can buy that stock at $40 a share if it's trading higher below the market. Are you with me so far?
Yes.
Which would mean that if you went out and bought a call option contract, that you believe that the underlying security and its market price built into your contract will rise in the market. You believe it's going higher. With me so far?
Yes.
Because you're looking to purchase that stock at a cheaper price than where you expect it to go. So when you buy call option contracts, you are Series 7 bullish on the anticipated performance of ABC in the market. Are you with me so far?
Yes.
You hope that stock price will rise above your strike price, and then through your contract, you can call away and buy that stock at $40 a share when it's trading higher in the market. You can buy that stock below the market price. You are bullish when you buy call option contracts. Look, the language call, the right to call away and buy, whether you put it in the form of an option terminology or just going out there and buying on margin or just buying in a cash account, buying is bullish, am I right?
Yes.
Or the right to buy is bullish, am I right?
Yes.
So the first type of contract is called the call option contract, which gives the buyer of that contract the right to step into the marketplace up until the expiration of that contract and call away, which is another way of saying what? Buying the underlying security at a fixed price known as the strike price, which hopefully will be below the market price of the stock. Therefore, you hope that the market price will rise in the market above your strike price, and therefore you are bullish on its future performance in the market. Are you with me so far?
Yes.
The other type of contract is called the put option contract. Always look at the trade from the buyer's point of view. The individual who went out and paid the premium to go along that contract. You go out right now and buy a put option contract, pay the premium. Are you with me so far?
Yes.
That put option contract would give you the right, if you chose to step into the marketplace, watch me, and put that stock out there at the strike price, which is another way of saying what? Selling the underlying stock. Are you with me so far?
Yes.
Well, to whom? Well, it's got to be to a writer on the other side of that trade. Are you with me so far?
Yes.
Because there's only buyers and writers. Well, what does that really mean? If you went out, paid the premium today, and bought a put option contract on an underlying security, are you with me so far?
Yes.
That you would have the right to put that stock to me at the strike price. In which case, if you decided to put that stock to me at the strike price, you would now become a seller of stock. Are you with me so far?
Yes.
And what does the writer become on the other side of that transaction? A buyer of stock. Are you with me so far?
Yes.
And watch how our roles just became reversed. When a buyer of a put option contract puts the stock to a writer, she's becoming what? A seller of stock, and the buyer on the other side of that transaction, and the writer on the other side of that transaction is now becoming a buyer of stock. Our roles just became reversed when the buyer of a put decides to exercise his right and put that stock out to a writer. The buyer becomes a seller of stock, and the writer on the other side of that transaction becomes a buyer of stock. Now, why would you want to consider putting that stock to me as a writer? Because you hope you can put that stock to me, which is another way of saying what? Selling the stock to me at a strike price that's higher than where you expect and anticipate the performance of the underlying security to move in the marketplace. Therefore, if you can put that stock to me at a price called a strike price that's higher than where you expect the performance of that underlying security to move in the market, then aren't you hopefully bearish on the performance of the underlying security in the market? Please say yes. Therefore, when you go out and buy, watch what I'm doing. I'm not writing calls, I'm buying calls. I'm bullish on the performance of the underlying security. When I buy put option contracts, I'm bearish on the performance of the underlying security in the market. Am I right?
Yes.
What if you decided to go out there in the marketplace, you bought a call, you were initially bullish on the performance of the underlying security, you hope the underlying security will rise above your strike price so you can exercise your contract and call away that stock, but in fact, the performance of the underlying security goes down in the market. What happened now with the call that you own, that you bought? Are you with me so far?
Yeah.
If you write the call to a writer, watch what I just said to you. For a buyer of a call to now write that call option contract, which is another way of saying what? Selling the call option contract to a writer, that's a bearish move. Because if you were bullish, what would you have done? Called away the stock and bought it at the strike price, because you think and you hoped that the stock price would rise above your strike price. By now writing your call to a writer, you're becoming a seller of a call option contract. I have to give you how much the contract is worth, which is known as the premium. So the writer gives a premium to the buyer of the call. Are you with me so far?
Yes.
Who's wrote the call to a writer? Are you with me so far?
Yes.
I am now long the call. I just bought it from you. You wrote it to me. Are you with me so far?
Yes.
We're still obligated to one another. Now, if I decide to call away that stock, I would be buying that stock from you. Are you with me so far?
Yeah.
And then transactionally, the contract's terms have been utilized. And so, when you write a call option contract, you are Series 7 bearish. When you write puts, 7, you are bullish. Because if you were bearish when you bought that put option contract, what would you have done? Put that stock to me and sold it to me at the strike price. With me so far?
Yes.
So therefore, writing calls is bearish, writing puts is bullish. 7. Agreed.
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 Yes.
Look at me. Agreed?
Agreed.
Thank you. I really needed that one. I just want to establish what these contracts gives you the right to do and what strategy you're really trying to establish if you buy calls or write calls, if you buy puts or write puts. Are you with me so far?
Yes.
And so, predominantly go out and pay the premium to own the contract. We'll get back to the premium. Are you with me so far?
Yes.
And of course, writers deliver stock to buyers, and that is if it's a call. Are you with me so far?
Yes.
Well, whenever you go out and buy any contract, just to get through to the rules of the game before we trade, whether you buy a call option contract, you buy a put option contract, I want you to know that you have 3 investment alternatives, 3 choices as to what you can do with your contract. Are you with me so far?
Yes.
This is for anyone, regarding any contract you buy. Choice number 1, let the contract expire worthless. You did not sell your contract, you didn't write it, you didn't call away the stock if it was a call, you didn't put that stock out there if it was a put, you did nothing. You let expiration roll around of that contract and let this contract expire worthless. Now, what did you pay to go along the contract? What is that known as? The premium. So what's the most amount of money you can possibly lose if you let your contract expire worthless? The premium paid. Choice 1, this is your choice. Investment alternative number 1, let that contract expire worthless. Your maximum loss is the premium that you paid. When does the contract expire? 11:59 p.m. Eastern Time. Watch your time zone on NASDAQ. With me so far? Are you with me so far?
Yes.
On the Saturday following the third Friday of the expiration month of October, that contract is worthless. Are you with me so far?
Yes.
It has expired, and the maximum loss is the premium that you spent and paid for to go along the contract. That's choice number 1. Choice number 2, liquidate your contract. I'll say it another way, in the language of options. Write your call to a writer. Write your put to a writer. When you're writing or liquidating, what are you doing? You're selling what? Contracts. And what is the market price of the contract known as? The premium. So look at me. If you went out and bought a call, or you went out and bought a put, and you decided to write that call or write that put to me, what does the writer have to give the buyer? The premium. That's how much it's worth. And what are you selling me? Your contract. Now I bought your call or I bought your put. We're still obligated to one another. Are you with me so far?
Yes.
And so when you write a contract, are you with me so far?
Yes.
Why do you write contracts? You write contracts for premium money. The amount of premium money you receive when you wrote your contract, if that exceeds the amount of premium you spent when you went along that contract, you're in the money. And making money on that transaction. So I think you'll find in a moment that more money is made. Are you with me so far?
Yes.
In the real world, in options trading, writing contracts for premium money than it is calling away the stock or putting the stock out there. Are you with me so far?
Yes.
Most people don't actually want to own the security. They want to liquidate the contract for its premium value. Are you with me so far? And wait until you see how much premium money you can make depending upon how many contracts you're long on your position, which I promise you and I assure you in the trade today is life-changing. Are you with me?
Yes.
Well, what's choice number 2? Sell your contract. Liquidate your contract. Write your contract to a writer. Are you with me so far?
Yes.
You're writing a contract that you originally bought, and you're writing it for premium money. If the amount of premium money you receive from a writer when you liquidate your contract to a writer exceeds the premium that you spent when you went long that contract, you're making money in the form of that transaction with premium money. Are you with me so far?
Yes.
Writing, selling, liquidating contracts. But one of the most popular choices on NASDAQ, not necessarily in the real world, in the real world the most popular choice is liquidations or writing contracts, as you'll see. But on NASDAQ, it is, of course, to exercise your contract, to do what the contract gives you the right to do. Are you with me so far?
Yes.
Now, why is that so popular on the 7? Because the 7 wants you to transact. Are you with me so far?
Yes.
And why? What do I mean by that? Well, if you look at these two choices a little bit more acutely right now, letting the contract expire or writing your contract, are you with me so far?
Yes.
Nowhere here with the choices of expiration or liquidation have you actually involved yourself with the actual buying or selling of the underlying security. Are you with me so far?
Yes.
NASDAQ wants you to transact. They want you to call away that stock and buy that stock. They want you to put that stock out there and sell that stock at the strike price to see how much money you made or lost in the end in the form of a gain or a loss, or maybe you broke even on your money. Are you with me so far?
Yes.
On your transaction. So the 7 wants you to transact. And so only when we use the word exercise are we actually doing what the contract gives us the right to do, which is to step into the marketplace and call away the stock at the strike price or put that stock out there at the strike price. Are you with me so far?
Yes.
Now, I want to talk about the 7 before we trade. So the last choice is to exercise your contract. Any contract you buy, you can choose to let it expire, you can write your contract, or you can exercise your contract. These are the 3 investment choices. Now, I want to divert for a moment into the 7, and I'd like you to look up real close at this. This is 7. They're going to give you option account information. Just like on the margin side when they give you margin account information, if you remembered margin. Are you with me so far?
Yes.
And then they're going to say, use the following option account information to answer questions 50 through 53. The question always comes in 3s for options. They did for margin too. Although those questions on margin differ, we said that there was one common denominator on the margin side, that those 3 questions, although different, associated with margin account information, surrounded itself with the common denominator associated with all margin trading conceptually, and that is all about equity calculations and equity adjustments, and when you had excess equity or whether you had restricted equity for same-day substitutions, for long buying power, short selling power. Those 3 questions on the margin side, although different, I'll say it again, were always about where equity was and its status. Are you with me so far?
Yes.
These 3 questions on options are always the same, and they will never change. Question number 50 is going to be related to the following option account information. What is this client's maximum gain on his option position, which they'll give you in the option account information. Question number 51 is going to be, what is the client's maximum loss? Are you with me so far?
Yes.
And question number 52, are you with me so far?
Yes.
Is anybody? What is the client's break-even point? Are you with me so far?
Yes.
It's all about the maximum gain, the maximum loss, and the break-even point on a spread or a straddle or an individual contract. And I think you'll find that when we review today again and we do some trades and you visit the strategies tonight, are you with me so far?
Yes.
It's pretty much rather simplified. Besides, I prepared all the notes for you because there's no ambiguity associated with a mathematical question. You see, one of the easiest questions on the Series 7 examination, although you don't feel that way right now, you will, is a question that requires computation. And I'm going to tell you why. You cannot create a distortion associated with an ambiguity regarding a mathematical calculation. It is what it is. It's straightforward. Are you with me so far?
Yes.
The distortions lie in the fine-pointed regulations that we went over, and there were so many associated with tax shelters and the retirement plans and the municipal bonds and the government side, which represent dangerous types of questions. Here, options are all about cash. It's really how much the investor lays out, how much money he got in, and whether he made a gain, he made a loss on the transaction, or he broke even on his money. And I'm hoping that you like cash. Are you with me so far?
Yes.
I didn't say that you have cash. I said I'm hoping you like cash, because I promise you, when I'm done with you today and tonight's your review, there is pretty much no ambiguity associated with this transaction. It's straightforward. And so we deal with the three choices, and before we trade, we want to go back to, so that's NASDAQ, but we want to go back to the premium. Are you with me so far?
Yes.
When we talk about the premium, we talk about the intrinsic value of an option contract. Its monetary value is what the words intrinsic value mean. And when you look at, plus its time value, by the way. Now, when we look at a call option contract, like the ones I have here for you, we ask a question: when is a call option contract in the money? When does it have financial value? Well, only when you have an opportunity to exercise your call option contract and call away the stock at a strike price, which is another way of saying what? Buying the stock at a cheaper price than where it is trading in the market. Are you with me so far?
Yes.
Otherwise, the contract has no value. Are you with me so far?
Yes.
So that would mean that if your market price is trading above your strike price of 40 a share, that contract has value, because through your contract you can call away and buy the stock at a cheaper price than where it's trading at in the market. Any stock price, any market price above 40 a share, that contract has significant monetary value. Are you with me so far?
Yes.
Now, if the stock was trading at $38 a share and you had a call option contract, which is the right to call away and buy that stock at 40 strike price, do you see where it's out of the money? Are you with me so far?
Yes.
How much out of the money is it? How many points? 2 points. Where is the value financially in buying a stock at 40 a share at your strike price when it's trading at 38? Are you with me?
Yes.
There is none. That contract would be out of the money. Are you with me so far?
Yes.
So a call option contract only has monetary value when the strike price, the Series 7, when the strike price, Series 7, is below the market price of the stock. Because then you would have an opportunity to exercise your call option contract and call it away at a cheaper price than where it's trading at in the market. Then it has value. You with me so far?
Yes.
So if the stock is trading at $46 a share in the market, look up. Look up. Not there. Look here. And you have a strike price at 40 a share. You can buy that stock 6 points below market. Are you with me so far?
Yes.
This contract has 6 points in the money value. Are you with me so far?
Yes.
Intrinsic value has nothing to do with profits. Are you with me so far?
Yes.
Or gains or losses. Are you with me so far?
Yes.
It just asks the question: does your call option contract have any significant monetary value? And the contract only has value when you can call away and buy the stock at a cheaper price than where it's trading at in the marketplace. What about a put option contract? Would that have any value if the stock price was trading above your strike price?
No.
What happens if you went out, watch this transaction please, and bought one put option contract at a 65 strike, May at 5? There's your premium. We'll break down the terms of the contract on a more detailed basis. Now, what does this contract give you the right to do as the holder of that contract? To put that stock out there at what price? $65 a share. Well, if the stock price was trading at $63 a share in the marketplace, then this contract means that you can sell that stock. Are you with me so far?
Yes.
2 points above the market. Are you with me so far?
Yes.
Now, you own that put. And you have the right to put that stock to me. I am a writer on the other side of you as the buyer of that put. Are you with me so far?
Yes.
The stock price is trading right now in the marketplace is $63 a share. You have the right to put that stock to me at $65 a share. Are you with me so far?
Yes.
And become now a seller of stock. The writer on the other side who is assigned to you has the obligation to buy that stock from you because you put it to me at 65 a share when the stock price is trading at 63. So you might ask a question from my point of view. Why would a writer on the other side of a buyer of a put option contract buy that stock at 65 a share when it's trading at 63? It is not that I am going out there in the marketplace, are you with me so far?
Yes.
And buying that stock 2 points above the market. I was assigned to you. You put that stock to me. A buyer of that put was matched with the writer of that put on the other side of that trade. If you decide to put that stock to me at 65 strike, I am obligated to buy that stock above the market. Are you with me so far? And give you $65 a share. Because we're not just going out and buying securities above the market price here. A buyer of a put puts the stock to a writer. I am obligated to you. You are assigned to me. I am assigned to you to buy that stock at $65 a share when the stock price is trading at 63. So we look at the trade from an option point of view. Are you with me so far?
Yes.
Because we're obligated to one another. And so, when does the put option contract have intrinsic value, financial value? Only when you can put that stock to me as the buyer of that put at a strike price that is above the market price of the stock. Are you with me so far?
Yes.
So Series 7, when your strike price on the put side is above the market price of that stock, does the put option contract have intrinsic value or in the money value? Are you with me so far?
Yes.
So, what do you have to know? What are the three components by order of priority to determine the intrinsic value or the in-the-money value of any contract? I'm going to give them to you one more time because you look a little nervous to me. Are you with me so far?
Yes.
And I don't want you to be nervous. The first thing you have to know is contract type, Series 7. You got to know if it's a call or a put. The second component is strike price. And what's the third component? Say it again. Market price. The premium has nothing to do with the intrinsic value of an option contract. Just to determine if it has value, type, strike, market price. Simple three numbers and three components. Are you with me?
Yes.
Good. I really believe you today. So that's one part of the premium, one component of the premium known as its intrinsic value. Are you with me?
Yes.
Now let's take a look at the other component of the premium. Look carefully here. The time value of an option contract. Do you know mathematically, please listen to me, there is no formula that will compute time value. How can you place a valuation, a monetary valuation on time? You want to know why there's no formula that will compute time value? I'll tell you why. Because time diminishes with the passage of time. Are you with me so far?
Yes.
Let me give you an example of what I mean. I know a lot of guys on the commodities exchange. Are you with me so far?
Yes.
Listen to me carefully. And they trade the air that we breathe. They trade air. Are you with me so far?
Yes.
You think, oh, I'm off the hook. These guys are crazy. They're great guys, but, I mean, they're trading air. If they can trade time, they would trade time too. Are you with me so far?
Yes.
Look, right now, please look at me. This split nanosecond in this moment in time, tell me how much it's worth. I'm sorry, you can't do that. It's already passed. Let's try that one more time. I want to know how much the split nanosecond right now, as I'm looking right at you and you're looking right at me, is worth right now in time monetarily. I'm sorry, you can't do that. It's already passed. Every time I keep asking that question, it keeps passing because time diminishes with the passage of time. Am I right?
Yes.
Because time diminishes with the passage of time, there is no mathematical formula at any one nanosecond point in time that will place a dollar value of how much time is worth. Are you with me so far?
Yes.
And that's why the market always assigns time value simple to be equal numerically to 1. You want to stay with me real close to me today, okay? If you can move in my house, you should try to. Stay close. The market price will always assign time value to be equal to 1 at any one point in time. Always, because there is no mathematical formula that will compute time value. However, please look carefully. There is, however, a point in time where the time value of any option contract exactly equals 0. And when is that? Look at me. At expiration. Watch this. Exactly at 11:59 p.m. on the Saturday following the third Friday of the expiration month of the month of October, that contract no longer has any time value. Time value is exactly 0 at that point because it's expired. Are you with me?
Yes.
Up until that point, the market will always assign time value to be numerically equal to 1. However, do you know that I have found a way to find a dollar value for time? Are you with me so far?
Yes.
I have found a mathematical formula, no doubt you knew I would, to compute time value. Are you with me so far?
Yes.
Let me show you how we can compute time value. If the premium were 3.5, and if the intrinsic value of a contract were 3, and therefore time value equal to 1/2, because IV plus TV is equal to P. Are you with me so far?
Yes.
Well, then that must mean that the formula for time value is that TV is equal to P minus IV. Are you with me so far?
Yes.
There's the formula for time value. If you take the time value of the contract, let me write this a little bit more legibly. If you take the time value of the contract, you look at the find and compute time value at any one particular point in time of the contract, and you take the premium and subtract the intrinsic value, that will always be able to give you mathematically the formula to find time value at any one particular point in time of a contract. Are you with me so far?
Yes.
TV is equal to P minus IV. 7. Although the 7 won't ask you to compute time value any longer. Remember many years ago they did things like that? Are you with me so far?
Yes.
Right now they're going right for the trade. I haven't done the trades yet. I just wanted to warm you up and give you some of the rules of the game. And the rules of the game are that we understand the definition of intrinsic value for a put or a call option contract. The rules of the game are that you go out and pay the premium to go along that contract. Are you with me so far?
Yes.
The rules of the game are, furthermore, that whenever you go along any contract, you can let it expire, liquidate, or exercise that contract. Are you with me so far?
Yes.
And do what the contract gives you the right to do. Are you with me?
Yes.
And now that we understand these fundamental concepts, I think we can do our first transaction together. Are you ready to trade options with me?
Yes.
It's a beautiful day for derivatives. I want you to go out right now and buy one contract on the underlying ABC. Month of expiration is October. Strike price is 40. The type is the call, and the premium, which is the market price to go long this contract, is expressed on a per share basis. Here the premium is 2. Times the number of shares per contract would represent the dollar premium that the individual has to spend to go along that contract. Each singular option contract. 7 represents a round lot on the underlying. Are you with me?
Yes.
I want to trade with you now. I want you to look at me. I want you to trade with me. Are you with me?
Yes.
It's 100 shares. You have the right to step into the marketplace up until the month of October at expiration and buy, call away 100 shares of ABC stock at 40 strike price. So you with me so far?
Yes.
The premium is $2 per share times the 100 shares per contract, because it's one contract. You have to lay out how much money to go along that contract right now.
200.
Good, you spent the $200. See, now you laid out that money. On the outside, you laid out $200. You're along the contract. Are you with me?
Yes.
Good. Why'd you buy the contract?
You want to go up.
You want what to go up? It was a movie by Stephen King. It was a clown. What? You want what to go up?
Market price above the strike price.
I want ABC to go up above 40 a share. Are you with me?
Yes.
Let's see if that actually does happen in a moment. Right now, at the time that you're along that call, that you spent $200 to establish a long position for the right to be bullish to call away that stock at 40 a share, what must the market price of that stock have been?
Under the strike price?
Excuse me, I asked you for a market price and you give me an essay. Look up. At the time that you bought this call option contract, with a premium that you spent of $200, relative to a strike price of 40, what must the market price of this stock, ABC, have been in the market? Well, if you said 42, are you with me so far?
Yes.
What is the premium of the contract?
2.
Premium is made up of IV plus TV? Yes. The premium is made up of IV plus TV? Yes.
Yes.
That means the intrinsic value must have been 1 and the time value was 1. Well, there's your time value of 1. Are you with me so far?
Yes.
But let's take a look at your intrinsic value. We have type, strike, market price. Well, if the intrinsic value is 1, that means that you could buy that stock at 40 a share. Are you with me so far?
Yes.
You said 42, correct? Well, if you said the market price was $42 a share, and your strike price is 40, that would give you the opportunity to call away and buy that stock 2 points below the market, which would mean that the intrinsic value was 2, time value is 1, that would have made the premium 3. But the premium is not 3, the premium is 2. Therefore, the market price at the time you were along the call could not have been $42 a share. What must it have been? Can I hear you? 38 is even more damaging. Because for the market, excuse me, because if the market price were 38 and you have the right to call away and buy that stock at 40 a share, this contract is out of the money by 2 points. Yet this contract has intrinsic value because the premium is 2 and the intrinsic value is 1 and time value is 1. Therefore, it wasn't out of the money, it's in the money. So it couldn't have been 38. Again, I ask you for the market price of the stock at the time that you bought the call for $200. Market price has to be $41 a share. Here's why. Because your call gives you the right to call away and buy the stock at 40 a share when the market price is trading at 41. Therefore, you can buy that stock 1 point below market, 1 point intrinsic value, 1 point time value. IV plus TV is equal to P. Therefore, that's the makeup of the components of the premium of 2. Are you with me so far?
Yes.
The market price had to be $41 a share because you forgot again, how do you determine intrinsic value? Are you with me so far?
Yes.
I can tell because your answers were wrong mathematically. The intrinsic value of a call option contract is only in the money when the market price is trading above your strike. What are the 3 components you need to determine whether it's in, out, or out of the money? You need type, you need strike, and you need market price. Are you with me?
Yes.
This contract only has intrinsic value when you can call away and buy that stock at a cheaper price than the market. Are you with me so far?
Yes.
If the premium is 2, and it is, and time value is 1, and it is, then the intrinsic value had to be 1. Relative to its type, strike, and market price, the market price had to be $41 a share because you buy that stock 1 point below the market. It's got 1 point in the money value. The time value is 1, that makes up the premium of 2. So at the time that you bought the call option contract, the market price of the stock was $41 a share. Now, what do you hope is going to happen to that stock price that's now trading at 41? You hope it's going to be going even higher. Are you with me so far?
Yes.
Look at me, because you're bullish, am I right?
Yes.
Am I right?
Yes.
You couldn't have been more right. Look at what happened to the stock price. It went to 45 a share. This contract gives you the right to buy 100 shares of that stock at 40 a share when the stock price is trading at 45. Look at the intrinsic value of that contract now. It's worth a lot more. The cheaper you can buy that stock below the market, the more value financially that contract is worth. Am I right?
Yes.
You can buy that stock at 40 a share when it's trading at 45. Are you with me so far?
Yes.
So the intrinsic value is?
5.
Time value is assigned to? 1. How much is that contract worth now?
6.
So let's take a look now. $6 per share times the 100 shares. The contract is worth how much money? $600. Are you with me so far? Now let's take a look and see some of your choices. What happens if you choose to write the call to me, writer? How much do I have to give you for this contract? How much is it worth? This contract is worth $600 now. It's no longer worth $200 now. You with me so far?
Yes.
So I would have to give you $600. What was your cost basis that you spent to go along that contract? How much money did you make per contract? So you would make a $400 gain, are you with me so far,
Yes.
if you liquidated the contract to a writer, because the amount of money in premium that you received, which is $600, exceeded the premium that you spent in cost basis to go along that contract. Am I right? So that's for one contract. You make yourself $400. Am I right?
Yes.
Now let's talk about the accredited investors who are out there buying and writing contracts. I'm talking about seasoned money. Are you with me so far?
Yes.
They're not buying and writing one contract. Are you with me so far? They're writing a lot more than that. Let's take a look at what it would mean if you wrote 10 contracts with a simple movement in the stock of how many points?
5.
No. 5 points, correct. 5 points. 5-point movement. Let me ask you a question before I do this trade. Do you really believe that a 5-point movement in a stock is too much to ask from the market? Well, it depends on the security. I could say that certain large cap blue chip issues don't usually move with significant swings, 5 points up and 3 points down. Those are big moves. But other securities that might be a little bit more volatile can move in that manner. Are you with me so far? I mean, we're not looking for an 11-point movement in a stock. I didn't ask for a 17-point movement. I didn't even ask for a 9-point movement. I talked about a 5-point movement in the stock. Stock goes to $45 a share. As a matter of fact, I'm not even really talking about a 5-point movement in the stock because right now the market price of that stock is trading where?
41.
The stock price goes to 45. That's only a 4-point rise in the stock's price. And I don't think that that's too much to ask. Do you?
No.
A 4-point movement in the stock from where it's trading at right now with your strike price at 40, what happens if you went out and bought 10 contracts? Well, then your original cost basis would have been $2,000 because it's $200 per contract times 10 contracts is $2,000. The 4-point rise in the stock, are you with me so far?
Yes.
You now write 10 contracts to me. The premium was worth $6 per contract. That's $6,000. You can make yourself $4,000 if you wrote 10 contracts to me. Are you with me so far?
Yes.
But what happens if you went out and you bought, if you will, 100 contracts? These are now some of the significant and normal positions when you're dealing with the option player out there. Well, that would have meant that your original cost basis would have been $20,000. Am I right?
Yes.
And of course, the original proceeds that you would have received would have been $60,000 with a 4-point movement in the stock when you wrote 100 contracts to me. Now let's really rock and roll and show you why we come into Wall Street. Are you with me so far? You went out and bought 1,000 contracts on the stock with an original cost of $2 per contract. Are you with me so far? Which meant that your original cost basis to buy 1,000 contracts on that stock was $200,000. A 4-point rise in the stock. Are you with me so far? With a premium now worth $6 per contract on 1,000 contracts means you get $600,000 in from me on a $200,000 cost basis. You can make yourself $400,000. Are you with me so far? And that's the kind of reason why we come into Wall Street. A 4-point movement in the stock. The original purchase of 1,000 contracts at an original cost basis of $200,000. Stock price rises 4 points. You write to me 1,000 contracts. I got to give you $600,000, and your cost basis was $200,000. You made yourself $400,000 on the writing of 1,000 contracts with a simple 4-point movement in the stock. You don't see that as life changing. Most people don't make $400,000 in 10 lifetimes. Are you with me so far? Yes. 4-point movement in the stock. You went out and bought 1,000 contracts. Stock price moved 4 points. You made yourself $400,000. That's a wow. Well, let's get back to the simplified mathematics in NASDAQ. Let's talk about one contract. Are you with me so far?
Yes.
And one contract, of course, with an original cost basis of $200 and the ability to now write that contract for $600 makes yourself $400 because the amount of money in premium that received from the writing of the contract exceeded your cost basis and premium that you spent to go along the contract originally. Are you with me so far?
Yes.
So we look at liquidation, and there's your profit. Are you with me?
Yes.
But now I ask you to look at this contract relative to that stock price of $45 a share, compared to your strike of 40, and it's a call, a different way. Look up. You would believe, if you looked at this real fast, this contract, a contract that gives you the right to call away and buy a stock at 40 a share when the stock is trading at 45. Are you with me so far?
Yes.
Why wouldn't you want to do something like that? Why would you even consider liquidating and selling the contract? You have a chance here. Are you with me so far?
Yes.
To buy this stock at 40 a share. Are you with me so far? 100
Yes.
shares on that stock, because it's one contract. When the stock price is trading at 45, you can buy that stock 5 points below market. Why would you even consider liquidating? Why would you not want to exercise this contract? Well, let me ask you something. If you decided, as you'll see in a moment, to exercise this contract and call away and buy 100 shares of stock from a writer, are you with me so far?
Yes.
At 40 a share when the stock price is trading at 45, are you really buying the stock through the eyes of your call option contract 5 points below market? Well, it looks like you are, but not technically, because there was a cost factor that was involved of a premium that you had to spend of $200 or $2 per share for the right to call away and buy that stock at 40 a share when it's trading at 45. Are you with me so far?
Yes.
Didn't come free. Your right to buy that stock at 40 a share when it's trading at 45 cost you $200 for that right. Are you with me so far?
Yes.
So the premium is going to eat away at that profit. Are you with me so far?
Yes.
Because of that capital cost outlay. And so let's take a look now at whether it's more profitable to exercise, as you can see here, or liquidate the contract. And you'll see why there are more liquidations going on in the selling of contracts than they actually are involved with the actual calling away and the buying of the underlying stock. People don't want to own the stock when they get premium money quickly. Are you with me so far?
Yes.
Because then you're responsible with the stock to have to sell that stock out to the open market, as you're about to see, and take the risks of wherever that market price is trading at to determine your true gain, and as I'll show you. So we study the exercise component investment alternative from this concept called a T account structure. Options are really taught from a T account structure. Why T? Because it's all about money laid out and money that comes in, and whether you have a gain or a loss or you broke even on your investment in the end. As simplified as I told you it would be. Are you with me so far?
Yes.
And on the right side of the T, we put the amount of money that we've laid out on this transaction. On the left side of the T, we put in how much money would we receive getting in on this contract. And so we put $200 on the outside because that's how much we had to lay out to buy and go along that contract when we originally bought it. Am I right?
Yes.
Now, if you decide to exercise this contract, it means you're doing what? You're calling away and doing what? Buying the stock at 40 a share from me, the writer. Well, that would mean that the writer has to deliver 100 shares of stock to you at 40 a share. And what do you have to give me for 100 shares of stock at 40 a share? $4,000. With me so far? Now the contract is used up. You laid out $4,000 to buy, call away 100 shares of that stock at 40 a share. The original $200 in premium that you spent to go long that contract, your total outlay was how much? $4,200, or expressed on a per share basis like NASDAQ, 42 per share on the round lot in the position. Am I right? Now, contract is used up. What do you own? You own 100 shares of stock at 40 a share. That cost you $200 for the right to buy 100 shares of stock at 42 a share. Am I right?
Yes.
I got your $4,000. We're used up. Now, what are you going to do with your stock? You own the stock now. The contract is used up. Am I right?
Yes.
What are your intentions? You're going to take your stock that you now bought and called away 100 shares of stock at 40 a share and sell that stock to the open market. Am I right?
Yes.
There's the risk. This is why most people don't want to call away the stock, because now that you own the stock, after you've used up your right to call it away so far,
yes,
then you're going to sell that stock to the open market and you will receive the market price. Now, what happens if you take your shares that you now own, so far, your stock, sell that to the open market, and you get a market price of $42 a share? Did you make money?
No.
Did you lose money?
No.
No. What did you do?
Broke even.
How do you calculate the break-even point for the buyer of a call option contract who exercises the call? Strike price, watch this, plus the premium. Why plus? Because you laid all this out. You laid out 42 per share, am I right?
Yes.
On your 100 shares that you are now long in the position by calling away your stock. Are you with me so far?
Yes.
So if you get any less than 42 a share, you're going to lose money. If you get more than 42 a share, you'll make money. But if you get 42 a share, you'll break even. Strike price plus the premium. Are you with me so far?
Yes.
And so, what will you get? You will now take your stock that you now own, your break even is 42 per share, and you're going to sell it to the open market. And you're going to get a market price of how much? 45 per share, am I right?
Yes.
How much money did you actually make per share? $3 per share. On the 100 shares that you now sold to the open market, you made out how much money in dollars? $300. Can you see it's actually $100 more profitable to liquidate the contract than it is to call away the stock because of the factor of the premium. Are you with me so far?
Yes.
See that? And so what we've just done is case one, call the buyer of a call, and establishes the break-even point and gain and loss. How do you calculate the break-even point for the buyer of a call who exercises the call option contract? Strike price plus the premium. How do you calculate the gain or the loss? Market price minus the break-even will determine your gain or your loss on the transaction. Are you with me so far?
Yes.
Good. On the call side. Are you with me?
Yes.
When you buy any call option contract, please look up. Let's buy this one. Let's stay with this contract. What's your maximum gain?
Unlimited.
Right. Why? Because the stock has no ceiling as to how high it can rise to. And of course, your cost basis is fixed here. You can buy that stock no lower than 40 a share, but the stock price has no ceiling as to how high it can rise to for you to call away that stock and buy it at 40 a share. So on the call side, your maximum gain, Series 7, is unlimited. Am I right?
Yes.
Series 7. But on the put side, if you go out, and I want you to right now, and buy a put option contract, and let's buy one ABC January 65 put at 5. Are you with me so far?
Yes.
Here's your contract. What's your maximum gain?
Limited to premium.
Limited to the premium?
6,000.
Premium is your cost basis. Say it again?
6,000.
No.
500.
Look at, no, sir. Look at me. Look at your contract. I ask you one more time. Why, I'm going to ask you differently. Look at me. What's the most amount of money you could receive from me if you put that stock to me? $65 a share. Am I right?
Yes.
You have the right to put that stock to me. 100 shares of that stock is $65 a share. You with me so far? Now, can the stock go any lower than zero?
No.
I ask you again, what's your maximum gain on the put side? It's limited to your strike price. You can't put that stock to me for anything higher than 65 a share when the stock price can't go any lower than zero. On the put side, your maximum gain is limited. Are you with me so far?
Yeah.
To your strike price, Series 7. Are you with me so far? Are you with me so far? You cannot put that stock to me any higher than 65 a share. If, at that point, if the stock price was at zero, on the gross proceeds, you can't receive any more than 65. Am I right?
Yes.
Now look at me. Look at me. Look at me. If you decide to put that stock to me at 65 a share, how much money are you getting in? 100 shares of stock at 65 a share means you're getting $6,500 in. Am I right? What did you have to lay out to go long that put? $500. You got this coming in. You laid out that. Are you with me so far? You laid out the premium, but you got the proceeds in from the exercising of your contract. So how do you calculate the break-even point for the buyer of a put option contract that puts the stock out there to a writer? Strike price minus the premium, because you laid out the premium, but you got that money in, strike price money. Are you with me so far? Series 7, strike price minus the premium determines your break-even on the put side. Are you with me so far?
Yes.
Because you laid out premium money, but you got strike price money in when you put the stock out there to a writer. Are you with me so far?
Yes.
And of course, you would only put that stock out there if the stock price was trading below your strike. Are you with me so far?
Yes.
Or you might even want to consider writing the put for premium money. Are you with me so far?
Yes.
So we see that there is a limitation with respect to the maximum gain on the put side. It's limited to your strike price, unlimited on the call side. Stock price can't go any lower than 0 on the put side. Are you with me so far?
Yes.
And of course, the stock price has no ceiling as to how high it could rise on the call side, which is unlimited in the amount of money you can earn by calling away that stock at 40 a share on the strike price of 40 on the previous contract. Yeah.
Question, Tony. If the maximum you can make is $6,500,
Less your premium when the stock price was at 0.
$6,000?
65, yeah, well, yeah, on your net profit, sure, because you have to subtract out the amount of money in cost basis you spent for the right to put that stock out there at 65 a share. I want you to understand something about the 7. The 7 is going to go into some regulations you're going to see right away. These regulations concern me very, very much, because most people concentrate so much on the calculations associated with spreads and straddles and buying calls and writing calls and buying puts and writing puts that they kind of get away from the important areas as well. And those regulations are what you're going to see right away on the first half of the Series 7 exam. And I want to go into some of those regulations right now for you. Let's take a look. We know when contracts expire, am I right? 11:59 p.m. Eastern Time on the Saturday following the third Friday of the expiration month. What about when contracts cease trading? All option trading ceases the day before expiration, Series 7 at 4:02 p.m. Eastern Time. Your client wants to exercise his contract. Are you with me so far?
Yes.
He wants to exercise, means he wants to call away the stock and put that stock out there. And so when is his deadline to notify the OCC through you of his intention to exercise? No later than the day before expiration at 5:30 p.m. Eastern Time. If he does not notify the OCC by that deadline, he no longer has the right to exercise. Are you with me so far?
Yes.
Look up. I'm going to NASDAQ now. Your client let that deadline pass. Are you with me so far?
Yes.
So now he no longer can exercise his contract. But the deadline is passed for the exercise notice. Are you with me so far?
Yes.
And the OCC sees the contract. They see it's about to expire. Are you with me so far?
Yes.
But they look at the contract and they see, the OCC, that the contract is 75 cents or more with intrinsic value, or 3/4 of a point or more with intrinsic value. Any option contract, listen to me carefully, that is 3/4 of a point or more in the money will Series 7 automatically be exercised by the OCC, even if your client let the deadline pass. Are you with me so far? They're going to automatically exercise it. Are you with me?
Yes.
Good. Now, we talk about the opening and the maintenance and the handling and the transferring and the closing of options accounts, which also represent a significant amount of regulation on the Series 7 examination. And so I want to talk to you about your client. Your client's been with you for 2.5 years. Margin trading with you, has a bond position with you. You are giving him investment custodial capacity ideas regarding his IRA and his 401k management. And you know this client pretty well, but he's never done an options transaction with you. Are you with me so far?
Yes.
Well, if that's the case, he is considered to be a new options customer. Are you with me so far?
Yes.
Even if you know him better than he knows his net worth and liquidity levels, it's irrelevant. According to the OCC, we must first, Series 7 Bullet 1, establish any client's suitability regarding a derivative transaction. So, step 1 of 5 in order of priority is to establish a client's suitability when wanting to open up an options account. So you establish a suitability risk file. Are you with me so far on this client? Step 2, that is exactly when, please look at me, you have to send your client out this publication. I have 2 of them here because I trade options every month and they send them to me as an options customer. And this document says what? Characteristics and risks of standardized options. Are you with me so far?
Yeah.
This is the risk disclosure document that you read about that must be sent out to the client. When? Point 2, after suitability is established. When? Look up. at or prior to account approval. I tell you when, you know exactly when I tell you. Are you with me so far? At or prior to the approval of this account, you have to send out this document. Now why? Well, because this document explains the risks associated with derivative trading. Are you with me so far? Yes. And the tax implications of option strategies. Are you with me so far? Which is part of your requirement and the fiduciary role to inform your client. So, at or prior to account approval, you want to send out this document to the client, which is the risk disclosure document by the OCC. Look at point 3. Point 3 says, then look to your registered option principal. Not your SHROP, not your crop, your ROP. Listen to what I tell you. This is a principal or supervisor that is especially assigned on the premise of the broker-dealer for option approval on options transactions, called the registered option principal or ROP. So you're going to look to your ROP, point 3, and ask the ROP to approve this transaction. If the ROP approves the trade, you then point 4, Series 7, do the transaction. Go out and go long the straddle. Execute the spread. Are you with me so far?
Yes.
Look at point 5. After the trade was approved, listen to me carefully, and after the transaction was approved and executed and the trade was done. Are you with me so far?
Yes.
Point 5, then you want to receive a signed copy of the options agreement where the client signs and returns this agreement back to you, the financial advisor, abiding by the rules of the OCC of derivative trading within 15 days, Series 7 of account approval. Very important number of days. Are you with me?
Yes.
And this is an amazing story that I want to tell you and share with you right now. One of the most speculative investments that we have in the market, derivative trading. We're going to do this trade before the client actually signs and returns a copy of the agreement abiding by the rules of options trading. And that's amazing to me, and it should amaze you, because you knew in day one that there was no agreement, there was no account, I should say, that we were going to open. Are you with me so far? Yes. And maintain as financial advisor without the client signing the proper documentation that facilitated the account opening process. Why, if you wanted to open up a joint account, you weren't going to open up that joint account without both the husband and the wife signing the joint account agreement. You're not going to engage in a margin transaction on the long side or on the short side unless he filled out the margin agreement and he abided by the rules of margin trading and he got approved for a credit check into his background. You're not going to open up any account, custodial accounts, investment advisory accounts, fiduciary accounts, before the client signs an agreement. Am I right?
Yes.
Yet here, for the most speculative investment that we have, you're actually going to go out and do a derivative transaction before he signs the option agreement abiding by the rules of options trading. Now, why would we do something like that? Why would we do the trade before he signs the agreement abiding by the rules of options transactions? Tell me. Why would we do something like that? You would normally think, what? Sign the option agreement, get approved by the OCC for options trading, and then I'll do the options transaction. Here, we're doing the trade before he signs the option agreement. Why would we do something like that? Why are you all looking at me like I'm on some kind of MTV commercial? I'm asking you a question. Give me a shot at this. We are doing this transaction before he signs that option agreement abiding by the rules of options trading. Why would we do something like that?
Already approved.
Right. Just because of the establishment of the approval by the ROP. You have a specialized supervisor here. If he says do that trade, you do that trade. He can approve that transaction even before the signing of the option agreement. Now, we did the trade. Look up. And now what are we looking for? We're looking for a signed and returned copy of the option agreement. When? Within 15 days of account approval. Are you with me so far?
Yes.
Look at me. 15 days go by after the trade was done. Are you with me?
Yes.
And the client fails to sign and return the option agreement. Now what do? Now we engage Series 7 in the maintenance and the handling and the closing of options accounts in the following regulation. You ought to engage Series 7 into a closing transaction. Now what does that mean? It means we have to close him to zero in his position and no longer derivative further transact. Now what does that mean? It means, look at me. If the very first trade that he did with you that was approved by the ROP, are you with me so far, was an opening purchase, he bought a call or he bought a put, that's what an opening purchase means, he went out, bought a contract, well then, simple. You have to close out that position. He could no longer be long. You must write that call or write that put so he no longer owns the contract. Are you with me so far? Yeah. So therefore, what is a closing transaction? It would close him to zero in his position. If an opening purchase was engaged, that is offset with Series 7, a closing sale. Series 7. Sell it. Write it. He can no longer belong the contract. What if the very first transaction, look at me, please, that he did with you was an opening sale? He sold a contract. He wrote a contract. Look at me. No one ever told you he was long that contract that he wrote. We assume if the opening sale was engaged, he was short the contract. Are you with me so far? He sold the contract that he was not long, he was short. What must you do? What is a closing transaction for an opening sale? That's offset with a closing purchase. Now you got to go out as a broker and buy the contract and close out the short sale, so he's no longer short or long a position in his contract. Are you with me so far? Yes. Opening purchases, Series 7, are offset with closing sales. Opening sales are offset with closing purchases, and the client can no longer be involved in derivative transactions if he should fail to sign and return within 15 days of the counter approval the option agreement. Are you with me so far? Yes. Significant regulations associated with the opening and the maintenance and the handling of the transferring and the closing of options accounts that I wanted to impress upon you for NASDAQ. And so, we take a look at these cases. Case 1, the buyer of a call. Case 2, the buyer of a put. And of course, the remaining cases that go into buying a call and a put on the same underlying security. Now, if a client goes out and he looks into the marketplace as this particular security, and he sees this stock is up 2 points and down 3 in seconds, it is maybe a day trading stock. It has a lot of volatility. Are you with me so far? Yes. We don't know from one moment to the next if she's going up or she's going down. But from one moment to the next, that stock price is going up and is going down with that kind of wide swing volatility. Are you with me so far? Yes. We ask the question from the eyes of an options transaction, how can we make money from a derivative transaction when you look at a security that has wide fluctuation? Well, the answer is you can try to box the performance on that stock through the eyes of an option hedging strategy called a straddle. Now, what is a straddle? It is the simultaneous purchase at the same time of a call option contract and a put option contract on the same underlying security. Now look at me carefully. If you went out, just listen to me, and bought a call on IBM, are you with me so far? And bought a put on IBM because you believed that IBM was going to swing violently, are you with me so far? What happens, listen to me carefully, look at me carefully, when the market price of IBM rises above your portion of your straddle known as the call strike price, well, then the call is in the money, am I right? Yes. But what does that mean about your put portion of the straddle? That would mean that the put portion of your straddle is out of the money. Are you with me so far? Yes. So what can you do at that point? You can exercise your call, are you with me so far, or write the call portion of the straddle when the call is in the money and still stay long the put portion of the straddle when the put is out of the money and wait for what? That stock price to go down, which you expect to, below the strike price on the put, and that's when the put portion will be in the money, and then you can write the put. Are you with me so far? Yes. Or put the stock out there. So what am I trying to impress upon you? By Series 7, simultaneously purchasing a call and a put on the same underlying security, Series 7 with the same strike prices, are you with me so far? Yes. You can make money on the call on the put side. The stock price rises above your strike price on the call side. The call is in the money, but the put is out of the money of your straddle. Stay long the put portion of your straddle, write the call or call away the stock and exercise the call, make money on the call side. Now what's going to happen is that stock price is bound to come down because you expect wide volatility, and now the put portion of your straddle is in the money. Write the put or put the stock out there for its intrinsic value. So the components of the straddle, known as the call, the put portion, can be exercised independent of one another or written independent of one another when you expect wide volatility into the stock's price. Are you with me? Yes. What about spreads? What if I say the following language to you? A call bull debit spread. What the hell does that mean? Well, debit means the amount of money the client owes. Credit is money that comes in, always, in any language. Are you with me so far? Yes. A call bull debit spread. A call bull debit spread. Spread money. You engage in spread transactions for premium money. Are you with me so far? Yes. It is a call and a put portion. Are you with me so far? What happens if you write more calls than you buy puts? Are you with me so far? What does the word writing mean? You're getting premium money coming in. What does the word buying mean? You're laying premium money out. If you receive more money in premium, listen to me carefully, to write than the amount of premium you lay out to buy, you're making spread premium money coming in. Are you with me so far? You engage in spreads for premium revenue. You engage in straddles to box the performance of a wide volatile stock. And of course, on individual contracts, you may be bullish or bearish to exercise or to write. This is not that complex. And the regulations that we discussed is significant for the first half of 7. Now, we're going to take a 10-minute break. When you come back, I'm going to tell you exactly what I want you to do. I'll see you in 10 minutes. Thank you very much. Isn't this fun?
Yes.
I'm thinking about whether we're going to film the next 10 minutes. I'm not sure yet.